outlook and stock review. And so you already know Roman. Roman has spoken. You know Bruce. Bruce has spoken. And we would like to introduce Corey. And so Corey Rosenblum has been investing and trading since 1999 and is the founder and president of Afraid to Trade, afraidtotrade.com, a website dedicated to helping traders overcome fears through actionable education. He is also the author of the complete trading course from Wiley 2011 and Profiting from the Life Cycle of Stocks, Strategies for Trading Each Phase of a Stock Trend, Wiley 2013. Corey incorporates his insights into trading psychology and edge optimization tactics through daily commentary, education, and research. And Corey has joined us on a number of occasions to do these market outlooks. And we've also had Corey come and speak in San Francisco at Golden Gate University. And he is one of the truly rising stars. He's just a great market thinker and an awesome individual, and it's really fun to spend time with him. So with that, Corey, welcome.
Good to be here, Bruce. Good to be here. Thank you for having me.
Oh my gosh, it's a pleasure to have you here. and so Roman, it's like, you know, it's like we get you two together, and it's just like I'm just happy to be in the energy of you guys.
It's an honor to be here with you all.
All right, so Roman, are you there?
Yeah, I'm here. Can you hear me? Yeah, everything's okay?
We can hear you. You're a little faint.
Oh.
Maybe that's just me.
Okay, is this better?
Sounds better.
Okay.
All right.
All right, well, I just wanted also to mention that Corey has had a chance. I had a chance to teach with Corey. We did a special together last year, and we were trying to combine the conventional technical analysis, that the practical ideas as to how you could trade, and Wyckoff concepts and strategies. And I thought that was a really, really interesting course. And then Corey did an introduction to conventional technical analysis for our students in March. And that was a really successful series as well. So Corey, I'm so happy you're back. We always have so much fun together, three of us especially, and this is the last session. I feel like the pressure of this whole conference is off. At least I feel that. I don't know, Bruce.
I think the pressure's on me, because that's all I can do to hang on when you two get going.
Yes, of course. So we're going to have a lot of fun. We're going to go through a lot of material during this session. This is actually an actual class that Bruce and I conduct on the weekly basis, each Wednesday at 3 p.m. Pacific. So for those of you who are interested, go to our website, sign up. We are having a promotion for the next 3 days, just for those sessions. So we'll talk about this at the end. Usually this session is all about the current market. If Advanced Wyckoff course is all about the knowledge, Wyckoff Practicum is about the practice. This is the course where you could ask all of the questions about the markets or the stocks. And usually we start our session with the market trend. Corey, this is something new that we've come up in the last, maybe like half a year. So just stay with us. Let's go through this, and then we'll.
Now, Corey, I want to tell you that Roman gets to rant. I don't get to rant.
I just listen. I'm here to listen and learn from you all.
He rants.
My rant today is going to be very quick. So the main question that I'm raising here is what drives the markets, right? So since the election time, we've had a very decent rally. Up to the Trump speech right here, which actually is a climactic action. So that was just a perfect time for the CEO, for the composite operator, to start unloading the stocks into weaker hands. And then after that, just a series of unfortunate events for the markets where there is always something during this session that might happen, some kind of threat to the market stability. So what drives the markets? And let's also look at where those events actually come. So we are talking about the geopolitical news. North Korea obviously is #1 right now. Syria, China trade, Russia, news from the European Union, then just news from the Trump administration. Obviously the Russian election investigation, firing of the staff, any type of tweets that would freak out everyone else. Then we have a lot of expectations on the policy effects that Trump administration wants to implement, and those are healthcare, tax reform, infrastructure, deregulation. And actually September is going to be extremely busy with all of those. They want to come back to the healthcare and see what they can do there. They want to start actually doing some actual work, legislative works on the tax reform. They also want to discuss the infrastructure. So September is going to be extremely busy. So that means some of these events are going to produce some volatility. So we should be aware of those. Obviously, Fed always brings us some news. There is a little bit of a sentiment lately that maybe even in December, we will not have an interest rate hike. And that just all tied up to the inflation numbers. So we usually would mention that during our sessions. Obviously, oil has just a effect, I would say, from time to time, where there is some kind of like an OPEC meeting or any type of announcements, reports on the U.S. And obviously, the biggest theme here is the OPEC cuts against the U.S. shale production. We definitely always have rotation in the market, and we've seen that with the technology stocks. We're going to show you the charts on that. And obviously, one of the brightest spots in the market is just earnings. Companies are actually making money and improving their revenues. So let's quickly look at where these events actually have happened. Again, very good rally after the election. Then healthcare proposal concerns. Syria, North Korea, right before the French election, Comey's memo on investigation, then his testimony in the UK election, then the tech sell-off that went into the trading range for the technology stocks, and then most recently North Korea and some rumors about Khan's resignation, who I actually regard as probably, he's being rumored also for the chairman of the Fed, which I think is going to be really, really stabilizing for the markets and pro markets. And obviously, just this horrific Barcelona attacks. I know I've seen from the signups that we have quite a lot of people from Europe, Spain, and our hearts go, to your families and everybody, involved. So we just, are thinking here about you. All right. So with all of these events, with so many volatility factors, let's look at what's happening here. And Bruce, I'm going to start here, and then I want you to jump in into this analysis with me, and then we'll go to Corey and look at his charts. So one of the things that I'm pointing out here is, despite of the recent volatility in the last week or two, and we'll talk about that as a potential change of character, change of behavior, look at all of the reactions that we have had since the lows here in November. 2.4, 3.6, 2.2, 2%, 2.6. These are not big reactions. These are not reactions that are measured as cyclical reactions. So we have not had really a really big cyclical bear reaction yet. And we still yet to see, for those of you who are bearish on the market, we still yet to see some kind of more meaningful structural damage before we're going to have a more meaningful reaction to the downside that could be like 10% or 15-20%. There is definitely a very important on S&P 500 support level, which acted first as the resistance level, and then it acted as the support, and now it's still going to act as a support level right here. and we should pay attention to that. And there are different support levels for the Dow and for Nasdaq that are extremely important. We'll go through that. The more intermediate trend, which started right here at this lows, and it contained quite a few support resistance points right here, is actually been broken. And this is where we are starting to see some kind of deterioration, some kind of change of character, at least a different behavior from what we've seen before. A reverse use of trend lines right here, catching a little bit of an overthrow, going into the latest volatility right here. And it still has some room, to go to 24. So there is a big intersection here with all of this support lines and resistance lines, and it seems that there is some kind of magnetic drive to this area right here. So I'm looking at two scenarios here, Bruce, and my bias is somewhat short-term consolidation with these swings that are possible between 24 and 2500. And my two scenarios here is we possibly, if we're extremely bearish, could break through 24, and that will be just a very big structural collapse for us since the highs of here of 24.90, and that would definitely put us into some kind of intermediate bearish outlook. Or we could just, let's say, right from here or from 2400 rally, and we see a little bit of the exhaustion to the downside, but not that much. And it's possible for us to rally, and we could possibly just be in the trading range, of a larger degree. Because if this is a change of character, we would be just consolidating around this level between 24 and 25. One last thought that I have is every time we had some kind of reaction, some kind of shakeout type of reaction, we always were able to rebound from this. Even this reaction right here, initially we have a stop in action, test, and then attempt to go up. Now this attempt has failed, but this bar does not excite me that much. The Friday action yesterday, I was trying to see how it's going to close. Is it going to close something like this after the shake? Something like this maybe, something maybe like this at the minimum, and yet we are registering the new low. So there is something different in the air, Bruce. What are your thoughts here?
Well, I agree, and of course we like to think in terms of scenarios. So if we do get down to the support level and also this the lower say demand line of this trend channel, it will be a change of character compared to the prior corrections in the uptrend. And so how quickly we go down there's going to be, I think, very telling, because this bar on Thursday was a pretty substantial bar, and it rivaled the one that came 5 days before. And so if we continue to follow through and go down to the area where there's support, 2400, we're going to have a bigger correction than any of the prior corrections, except for maybe the first one. And the next thing that I would be really focused on is how well it can rally off of 2400. If it can go there, how well does it rally? And if it acts more like it's under the ice, or it just sort of like, say, bounces around between 24 and 2420, then that would be a very poor quality response to that decline. And so that's kind of what I would be concerned about seeing. And maybe we'll get some additional evidence by looking at some of the other indicators or other indexes as we move through some of the other charts.
Okay, well, let's go to Corey. Corey, this is your chart right here. Bring us up to date on what's happening with the conventional technical indicators.
Absolutely. Just on this, what I'm showing in terms of those who aren't familiar with the method is just the 20-week, it's green, and the 50-week exponential average with just typical Bollinger Bands. So nothing really special or out of the ordinary. We're looking at a momentum oscillator. That's the MACD color. And that's just essentially, you can use rate of change or momentum and different things to do, but it's kind of a custom indicator that shows the concept of confirmation, non-confirmation, which is part of Wyckoff and of course Dow theory. So that's what I use a lot. So it is non-confirming, you're right. That is a negative divergence. That has me worried as a technical purist through here. Also forming a little wedge, kind of a bullish rising wedge. You can sort of see, yeah, I would say right, the three. That's also got me concerned. And the volume signature. So, and we'll see this on a lower time frame, but the buy or bullish green volume, that's essentially drying up. And I'm comparing this to what we saw in 2015. So it's a sort of similar, I wouldn't say repeat pattern, but volume was drying up at the same time, early 2015, as was momentum. And that exactly same little consolidation wedge. And of course, what happened next was not fatal for the market, but it was, in Elliott terminology, an ABC, which is a large move down, a reaction back up, and a final leg down, exactly. And that was just part of a larger picture. So in the past two briefings that I've done with you all, we've talked about the market, and Ramon does well with this too, that the market's probably in some type of fifth wave, which is a terminal wave, but it's got more room to go. And so as we were plotting this out, we probably were in the third portion of that. So without being too complex, it appears to be that under this count that I've given you, the market is terminating that fifth wave of third. So again, not calling for a major reversal, collapse, and all kind of terrible stuff, but I do want to call the attendees' attention to the 20-week exponential. So just in terms of trend methodology, exactly. So when trends move, you can go back to 2014, 2015, and all the way up in 16 to present. The market typically pulls back to that average, and that becomes a good spot to buy. But when it breaks or shatters that average, that can lead to some negative outcomes. So we're there, and as Bruce said it really well, we're not, in this case, predicting, we're just looking, planning, and strategizing. So as we're looking at it together, if this market does fail or falter or break under the support levels you showed and this weekly moving average, I think we're probably going to trade down toward that 50-week exponential. And that's just above, it's going to be rising, but about 2350-ish. The precedent for that, of course, is the two other examples in 2016 and to an extent back in 2014. So okay, I would say neutral support. If it starts to break this, I'm with you both. What you said, this can be a pullback lower.
Couple of interesting that we have. I'll just say this briefly. We do have higher point and figure counts, and so we have some that kind of go into the area, and we have those for later. But we do have higher counts, which I think are consistent with your fifth wave scenario.
Yeah, and this could extend that. The fifth wave does not mean it's complete. When we're talking a fifth wave in Elliott terminology, it essentially means it's going to keep going until the market breaks and gives us a signal. So you're exactly right. It doesn't mean the fifth wave is terminated. It doesn't mean it's finished. But it certainly, if the market does fall further, we would suggest that.
Okay, so a couple of questions, maybe like clarifying questions, and some of the, let's go into some of the analysis right here. So first of all, the wedge suggests, especially in the fifth wave, suggests what kind of character of the move to the downside?
Well, I'm not optimistic, and we'll see on the, essentially try the SPY in a little bit here, but the volume signature is even more pronounced on the ETF than on the index in terms of the last 2 weeks.
And when you say that you're not optimistic, what does that mean?
I try not to be directional. I try not to be a bull or a bear. I try to be objective with it. But if I were coming from a bull perspective, these are things that I don't want to see. I don't want to see those massive red candles. That's essentially the largest 2 down weeks we've seen for quite some time, really since there. Yeah, really, that's about all 2016. And that doesn't bode well for the supply-demand relationship. If this is a bull market, the market needs to be pushing higher volume, higher momentum, higher efficiency, and those sort of concepts. And those 2 bars suggest I would say, change in character. So that's something that we haven't seen in some time. And you're right, Ramon. The last time you circled the examples there, all those instances showed a lower future yet to come. So we're kind of plotting that at this moment.
Yeah, and am I correct or not? And I'm just trying to solicit an answer here about the wedge. But I think that when the wedge in the fifth suggests, a high velocity to the downside when there is a break, because there is a selling that is going into the rising prices, and that's what creates that wedge type of formation. And when the market is ready to go down, it's already so sold that the velocity is increasing, and usually the wedge formation, would put the price down, to the at least to the low of the fourth wave right here.
That's 100% correct. 100% correct. And the only time we can look back for an educational example on that would be the start of 2015. Now, one little caveat: markets can push. I call them decayed, or when the market essentially dies internally. You're right. What I mean by that is the selling pressure is taken over. The larger funds and et cetera have been selling, and the general public have been buying. And that's how tops or short-term reversals typically form. It's the insiders doing one thing, the public doing the opposite. So the precedent would have been 2015. But even that, look how long it took before the market had that huge red bar. I would argue where I put my 3 right over. Yeah, it took really a couple of months. So I think,
and that's the second scenario that I was trying to discuss here. Yeah. So what if under the second scenario, using the 20 moving average, we just slightly going down like we're doing here, then we're having an attempt to go up, some kind of excitement, I don't know, some news, and then after that we're actually going down, let's say to this area right here. This seems, in terms of the Wyckoff terms, probably more plausible, because we want to have that break first. We want to have that change of character, and then an attempt to go up as a failure, as a low or high right here. And that's what 2015 is about. Okay, and then I also, Corey's point about momentum was so spot on, I think. Look at this, guys. I mean, it took approximately even the same time to develop that momentum signature, where you have the momentum going down and the price and ability, to make the new highs in 2015. But we have overexcitement with the markets here, so it's a slightly different picture. But in terms of the volume and momentum, kind of the same.
Yeah,
I'm glad that you're bringing this up to us, Corey. All right. What about the daily?
So this is the SPY. I wanted to show us something a little bit different in terms of the ETF. The index is obviously the index, but this is a tradable and very popular exchange traded fund. So what calls my attention, the yellow spikes, where that's, I would argue, and which is what Ramon was saying. It's a distribution volume. You're seeing spikes or increases of volume on sell days, or call them distribution days, or just days when the market goes down. That's not something you want to see in a bull market. Or not bull market, but in a market that should be making higher highs, like you saw in January, February, and March, particularly. So when momentum, just for as a principle reference, we talked about this in the classes we did, when price makes a higher high, for example, February, March, and momentum confirms it, which also makes a higher high, or goes up, right? Price goes up, momentum goes up, and then also volume goes up. So you really have the triple confirmation. That is a super bullish method. It's Dow theory, to an extent Wyckoff in a roundabout way, but it is confirmation. It suggests the future of the market will be higher, or that the trend in motion will continue. And that's what happened. But trends don't go up forever. And so when a change of character, when things start to fall apart or distribution internally happens, you're going to see it in volume. If you look, you'll see it in momentum and other factors. Exactly. So you'll see it both in divergences, which is where the price is making higher highs in an uptrend, but momentum or volume, especially volume, is making, it's not so much making lower highs, but it's trending lower. So as price goes up, the participation, the activity, the volume, the transaction of shares, especially on bullish days, declines. Then the second part of that is what you're highlighting there, or what I highlighted, which is the spikes or increases of bear/sell volume. And I hate to use the word worried, but that's what has me worried in terms of a change of character, potential reversal.
And we could clearly see that the demand signature right here is so much different than in this area, even though the price is going up. Corey, what about the short-term picture? I mentioned that I have a little bit of the hesitation about the Friday's action, just because it did behave differently than in other shakeout type of situations that we've experienced in this late market. But here, we still could have some kind of bounce, and I'm actually expecting some kind of rally. I'm just not expecting maybe a very strong rally. I'm expecting actually a rally that is going to be less than this rally right here. So, and I'm looking at the divergence here where the price goes lower, but yet the momentum is already creeping up a little bit.
Yeah, and that's consistent with my analysis too. The green spot is going to be a bullish, I would call it alternate thesis break. So I do give the market room to run up toward those averages, which is about 24 or 245 in the S&P or SPY. So it can push into that zone. If it breaks above it, I'd say 246, that could be an alternate thesis bullish trigger or a short squeeze. The dominant thesis at this point, you're right, is to swing or wave its way lower. Markets don't go straight up or straight down. They wave, they swing, they impulse, they back and fill, they rotate, they alternate up, down, etc. But it forms a trend, and we call that market structure by the lows and the highs. This is clearly an uptrend, and that hasn't really been broken until Friday. You had a little push to a new tiny, but still swing low. Right, so I do think the market probably has a chance to go up. I think it may fail at those resistance levels. And I really am focused on 2,400, which is the S&P level, or in the SPY, $240 per share. That's where I have my red, the same as you. And again, we didn't do this at the same time. We did separate analysis, but we really come to the same conclusion.
Did we?
Yeah.
We usually do that, right? And then we compare the trades, and the trades are the same. Yeah.
So does Ramon. When I first met Ramon, we were talking about Apple, talking about Netflix, and just general things like that from a few years back, or even current trades we were in. And we found out we had entered at very similar points with obviously with much more knowledgeable and educated with Wyckoff than I am. But the trades were the same, and that's what I get so excited about. It's like, yes, it works.
Yeah, we should compare the trades. And Bruce had a number of great trades, Bruce. Before we go to Bruce, I also really like what the moving averages are doing here, the 20 and the 50, right? If I'm looking at this correctly. So look at this scenario right here. Look at this scenario right here. There is kind of like a Bollinger Band type of contraction and then expansion, right?
Exactly.
Contraction and then expansion. So, and you've talked a lot about that in your courses. And it seems like there is a contraction that is happening right here. And I'm thinking if the price will try to go up and then kind of consolidate like it did here or like it did here, that's going to contract this relationship even more. And then out of that, we're probably going to have a pretty good momentum move.
That just for principal references, we use three principles. The first is that trends, once established, have greater odds of continuity, which is, I think, clear to everybody, should be at least. And the third principle isn't as clear. It's that one. It's that the market or price alternates between range expansion or breakouts or sustained movement up or down, example February, or contraction. So we're either going to expand like that or consolidate or contract. And it's just the third principle that we use. That's the foundation for breakout trades, really.
Okay, great. Well, let's look at the Dow. The Dow was actually outperforming for quite some time. And I want Bruce to talk about his PNF counts that he has published on his blog. And they are right here. Bruce, what were those two counts that, you keep talking about at Market Outlook sessions that we basically hit them, right?
Well, here we can see that there's a count from earlier in the year. Now, this is 60-minute data. If you have a subscription to stock charts, you can do intraday data, which is slick. And here we are using ATR 20 calculation to determine the scaling of the boxes. And that gave us a 47.85 box size. And so we calculate across, we can see that this count that goes from May back to March counts up to 22,250, 22,441. And so that count, which at the time seemed pretty far away, but here we are. And then as we jumped out, we backed up and we made another count. And so this is a reaccumulation count, which is what Hank talked about. So these concepts work on really big time frames, such as Hank talked about today, and also in smaller time frames. And so we can see here that we have a count that somewhat approximates the bigger count, which is 22,202 to 22,298. Well, the Dow hit a intraday peak of, I think it was 22,179. So basically it got within 25 points of hitting the half a box of hitting this this count, and a box and a half from hitting the 22,250 count. And so that's pretty close. And so sometimes, and that's the thing with point and figure, is that it might be that this we pretty much fulfilled the counts that were set up in these accumulations, unless something dramatic happens and we can turn off of this and then run up to these higher levels, which is entirely possible. So we're pretty darn close.
All right. And just looking at the chart itself, the vertical charts here, Bruce, overthrow usually would happen around the climactic action. Then I'm looking at this trend right here, which was broken. And it seems like the Dow is actually somewhat weaker than S&P. What do you think about this most recent action, and what does it mean in your view right here? What could possibly come here in terms of the Wyckoff labeling?
Well, so this is interesting, and I do this a lot on the blog as I try to cover these concepts as much as I can with real life examples. And here you can see that we have a reverse use of trend lines, which is these two touches that are over the market, and sometimes, and then we have two touches below, and that sets the stride of the advance. So since April, there's been a stride of the advance that's been taking place. We draw a trend channel, and then what we look for is we look for exhaustion. And exhaustion comes in the form of a buying climax, which oftentimes is accompanied by a throwover. And so that's exactly what we have happening here. And for the trifecta, we've gotten within about 23 points of fulfilling the point and figure count, which is this upper blue shaded box. That's approximately the area of where this count is. And so we're very close to fulfilling half a box from fulfilling this count, and a box and a half from fulfilling the bigger count. And so now the thing that is compelling here is not just that it threw over, because market can throw over its trend channel and just go and go and go. So it's just accelerating the rate of its advance. But you can see here that it accelerated the rate of its advance with ever higher lows throughout the course of the trend channel, and then it threw over and had what we described as a change of character. And so you can see here that all of a sudden the volume is expanding, the bars are expanding. Look at the nature of the rally that goes up to the trend line, and so the bars are tightening, diminishing, and occurring on lower volume than the down day bars, and the down day bars are coming on wider volatility, expanding volatility, and Thursday's declining bar was bigger than the one that preceded it. And so, and then the following day, we just continued to have more selling, and the volume was high. So this is a change of character. Now, this is a short-term concept, and it's possible that once this is over, as we just described earlier, it could be ready to go again. But for the time being, we have the weight of the evidence suggesting that lower prices are, maybe I would say likely.
All right, and
in the low risk place and to enter a trade was on the turn off of the throwover. Was right there as a throwover was a place to take a trade in the Dow, and then the secondary test, well, actually at the buying climax. So that would have been one place that you could have put on a tranche, and then the next place is on the secondary test.
Okay, and obviously if this is a climactic action, and if we're talking about the change of character, we have some targets for the industrials. 21,400 is actually a really interesting target because of this consolidation right here. So then this change of character could define some kind of more or larger, bigger trading range, and we could have something like what we've had here, or maybe even a slightly larger degree. Okay, we've talked about this during Hank's presentation a little bit. Bruce, really quickly here, just confirming counts, even from 2009, which, by the way, was kind of funny because we always use this count, and then, you know, when we looked at this one and compared it to this one right here, I think this one right here, they do match. And we have kind of like, you know, a very big large count that goes beyond of the short-term activities in the market that we have, but the ones that are minimal counts, they're just like in the same area right here.
Yes, and so we just have to really keep that in mind. And there is higher prices, there's higher potential from here, and we want to keep that in mind. And I like Corey's idea of this being the fifth of a third, and that there's a fifth out there ahead, and possibly we're going to build a reaccumulation count in a fourth wave that will generate the counts to these higher levels, and that would be wonderful to see that. And so there is some evidence of the potential for higher prices in our point figure work.
So Elliot is pointing that long term, not short term, long term, we could have another wave up. Point and figure has some counts, you know, long-term counts, not short-term counts, right. And yet short-term we're just experiencing that type of volatility. All right, let's look at the composite. So composite has been under the rotation for quite some time. We had a big sell-off as a change of character here at the beginning of the trading range in June. That kind of defined the range, even with the most recent rally that we've had in July, which was leading all of the markets at some point of time. We still have an upthrust action right here, and I would argue, Bruce, that, you know, structurally we probably still in phase B, and until I see something here happen, either the price is going to drastically commit to the downside and has an ability to rally and then fall, so this type of action would be more bearish, or it just bounces off the support and comes to the resistance. I probably would still be labeling this as phase B, and then my questions would be structural questions, whether we are in B or in D phase. What do you think about the structural analysis here?
Well, I think it's smart to tactically think that we're in B, and of course I know that most of you have done a lot of phase work, and so phase B is where you really build point figure count, where you do a lot of trading back and forth between resistance and support. If I was to be a little nuanced here, and look,
which we want you to be.
Look at the trend channel analysis. Look at how the demand line. Look at how the upthrust was able to go slightly through it after failing it, and it immediately gets back below it again. I would say that if we had a decline here that went below, slightly below that sign of weakness in B that you have labeled, that would be maybe a bigger sign of weakness, and then we would see a rally from that, and that would be, which could be a rally into a last point of supply, and that could very well be the thing that puts us in phase C, something like that. And so I would be very interested in whether or not the market can go down and take out that sign of weakness in B, and if it can make a higher low above that, that would be, I think, encouraging for the bulls.
Corey, how do you look at this structure here in NASDAQ? I mean, obviously it's so different than the Dow or even the S&P.
Yeah, I don't do the deeper level Wyckoff, but just looking at the similar, you're seeing the weakness given that how it's pulled back and it's really kind of even lower. So the technology names have gotten, I won't say pummeled, but have declined recently. So you are seeing the relative weakness here, given that the high was made really in July on that. So I don't have much more to add with that, but just the same level is about 64 on this, or sorry, 6100. There's a little downside support potential pivot, which overlaps with about 2400 in the S&P.
So, and 21,400 on the Dow.
Yeah.
You know, Corey, the animal spirits, you can see those in that long trend channel.
Yes.
You know, sort of the animal spirits are really in the NASDAQ and in the semis and in the NASDAQ 100. And in your experience, when you see the animal spirits come out of leadership like this, what tends to be your experience about what happens next?
Yeah. Go ahead.
Sorry.
Well, the general thought thinking is that the NASDAQ and the smaller cap Russell tend to lead on the upside. So if they're emerging, let's say, from a bear market, they're making higher highs, while the S&P and Dow, they tend to go together. If they're not, that's a sign of strength just coming from the technology names, but the exact opposite is true like this. Again, the NASDAQ is going more sideways compared to the S&P chart there. And of course, the NASDAQ made a little bit of a big reversal day under 64.50. And right, so you're having the S&P go higher, made a higher high just recently. The NASDAQ did not confirm that. That's considered a Dow theory type of non-confirmation. The NASDAQ made its high earlier, and right, so the NASDAQ made a lower high when the S&P just gently spiked up and reversed from a higher high. So given that the NASDAQ is arguably more sideways and the S&P is more trending up, and the high was made earlier in the NASDAQ, that's not, again, it's just one of those little, you're building a case like a lawyer. It's not bullish. This is not something that should be happening in a bull market. Well, I said it's a bull market. If you think the market's going to continue this strong uptrend, it's a non-confirmation signal.
Mm-hmm. All right.
Excellent. Thank you.
Okay. So let's look at Russell. Corey?
Yeah, not much difference with this with respect to the S&P, although it's a little more volatile. And it's pulled back you'll see in the daily chart, has pulled back stronger. So remember our target for the S&P, if the market, just go back to our thesis, if the market fails at the 20-week exponential, at 2400, it will probably fall about 50 points lower to the weekly 50 moving average. Well, the Russell's already done that. That's what's happened. So that's sort of the play you're looking at if the S&P follows suit. And as Bruce mentioned, if these so-called leadership, the NASDAQ and small cap Russell, if that does wind up to be true and leadership is being shown that the market will falter, then this is a picture of what we can expect. And again, the thesis, if the S&P and Dow break their weekly support levels where they are now, 21,000 and 2,400, then you'll probably see it go to the weekly moving average. Again, the Russell has done that. And the same logic applies to 2015 when the market peaked up where I have that third wave and then an ABC down. So this is a deeper pullback. It is more, I won't say more bearish, it's more bearish, but it's more of a warning sign. One thing that gives me a little bit of happiness as a bull, I guess, but is that the red volume it's not low any means, and it's actually in fact surging up, but the red volume of the last 2 weeks is not as high as it has been, although it was higher than that. So you're seeing a slight rise in bearish volume. So this does have a bounce play off of about 13.5, just to be simple. A little bit less than that, but 13.5 in the Russell, that is a potential bounce play that would go along with what we're thinking about in the S&P. But once again, exactly, so price support, EMA support, 50-week exponential, and the lower Bollinger. So the odds do favor are setting up for a potential bounce in the Russell, and that's okay. If that doesn't happen, we always say if something should happen but does not, it often leads to a larger than expected movement in the opposite direction. And I would be really, really cautious to be any type of bull if the Russell makes a new price low beneath 13.4 level.
Mm-hmm. Very interesting. It seems like, three of us are building the case where we're still in a very secular or cyclical up market since 2009, 2015, 16 lows.
Right.
Then intermediate wise, we are in somewhat of the consolidation with the two short-term moves, the one that we just had the last week or two to the downside, and then a potential very, very short-term potential for the bounce up of the key support levels. And I would be again looking for what kind of character of the rally we're going to have here, because this type of the reaction in Russell is not new in this uptrend since 2016 lows. Look at this reaction right here. Look at this reaction right here. But every time there was enough momentum, which usually is associated with institutional buying, because institutions are seeing short-term value in the long-term picture, they're coming in, they're providing some buying, and that creates that momentum, and then we see this momentum as the depiction of the price spread increasing. If we are not gonna see that type of momentum here, and if we're going to see some small spread attempts to go up maybe to 1/2 of this decline right here in the same time period that we had recoveries from these lows right here, this is probably going to tell us a story about a weakness, a further weakness, and a possible another attempt to go and retest not only this support, but as Corey was saying, maybe even go lower somewhere here, Corey, right?
That's right. That would be your prior support levels. That would fulfill the ABC fourth wave that Bruce was talking about, which builds a case in the future, 2018 possibly, for a rally way up to the highs. But yeah, that we're building a case for an ABC is ultimately what I'm.
Hold on a second. Bruce was talking about Elliott waves.
Oh, what happened? He did. He was exactly
what I do in my spare time.
Oh.
Yeah.
Secret Elliottition.
Yeah, secret Elliottition. Okay, sounds great. Okay, well, this is the daily. Okay, so what are we seeing here with daily?
Yeah, we threw some fib up in there, so to confuse you all further, I got some Fibonacci retracements. Let's start with that. So just simple, no frills Fibonacci retracement. Start with the prior low, draw to the prior high, and that puts us at a 38.2 retracement at about 1335. That's about where we are. So what gives me a little bit of pause is that for the first time really in 2015, the Russell, the Russell has breached or broken under its 200-day simple average. And we don't talk about that much. We haven't discussed it in the S&P or NAS because it hasn't happened. It's not even that close. But we also look at the 200-day simple average. And if you are, none of you are, but if you're a major fund manager who does not look at technical analysis, I know we all do, but if you don't look at technical analysis, you just look at fundamentals and earnings, you might look at, or you probably do actually, look at the 200-day simple, and that's about all the technical analysis you might do. And so when a market or a stock begins to breach or go under the 200-day simple moving average, that itself can be self-fulfilling. That can create some liquidation, some selling, or the opposite. If it gets above it, can create some buying. So that's something to watch, even just for self-fulfilling prophecies. But the Russell does, and just it goes along with the weekly. I'm building a case essentially. I think Roman is too. Same different logic, but same concept. That the Russell probably does bounce from these levels. Probably bounces maybe as high as 1400, 1380-ish level. And we a trend line as well, so probably goes up, and right, probably will test, which means touch, and you're exactly right, exactly. Touch these moving averages, and we will see what happens. We do not predict, we're just making scenarios. And certainly the scenario is, that's what we expect, is a bounce toward those averages, and of course the trend line. If it goes beneath it and fails at this 38.2, which is the weekly moving average, 1335, you probably will see it try to move down lower towards about 1260. So you have an up rally short term, but eventually a possible, if it fails, that would be when the S&P breaks 2400, so on and so forth. The Russell will do it too. They'll all trade toward lower support targets. That's what we're looking at. Volume, and you can see it a little bit clearer that the divergence is locked in from May to August. I would call this a triple swing. It's 3 swings, or 1, 2, 3. negative momentum divergence with price, and volume is off to a pushing up in the bear volume. So that is giving us pause for the moment.
Wow, that's so beautiful. Look at this trend lines right here, and look at this.
Oh yeah. We didn't. Well, I promise you, we did not correspond at all with our charts.
We have to find that somewhere. Bruce, we were looking at this actually somewhere here, I think, on this rally, and it actually looked pretty bullish. We were looking at this spread right here. They were very, characteristic to the, sign of strength, especially this rally right here. Obviously, every time it goes up, it goes down, and then for the first time, it stayed there. The reaction was shallow. There was no so much retracement, as we've seen before during the consolidation here in Russell. So that looked really bullish. Then, attempts to break out. This bar was beautiful, and then everything collapsed. So what kind of principles, if we're thinking about institutions, what are they trying to do here? What kind of story are they creating for us here?
Well, this has sort of the characteristics of an upthrust after distribution. And you can see that there's just sort of a minor throw over there at the end. And Roman, you're really good at doing the trading range that's in a rising trend. And so it sort of appears as though we have a trading range that has an upward tilt to it. And it's working out really beautifully. And the thing that we, in Wyckoff, when we get an upthrust after distribution, what happens is that we get just a liquidating market, and that comes after that. There's no reason for the CO to hold that market up anymore, and that's exactly what happened here. Is that it just marched right from the resistance line right to the support line, and then look, it has a little bounce and a very short-term, very meager bounce, and then it just gets back in gear again and starts to turn back down. That's classic UTAD kind of behavior. The thing that we do as Wyckoffians, because we will often want to try to go with a good rising, good breakout, is the rule is that when you, after an upthrust, if you return to the midpoint of the trading range, so in this case you're drawing a rising trading range, you get to the midpoint of the trading range, then it negates the breakout. And so then you start to think in terms of a distribution with an upthrust in it. And you can see what happened at the midpoint there, that you had a short-term pause, and then that last bar, so it has no lift in it at all, and then the last bar has a big tail, and then it just turns down and just marches right to the low. So it's that in the midpoint is when you become, if not before, you give up on it. You say this is a change of character, and I need to not be here.
Bruce, and there are also a couple of other points as to the character with which the price moves down. What really bothers me is in the previous instances, at the termination of the down move, we do have somewhat of the climactic nature of the spread and obviously the volume. But look what happens here. Every time there is some kind of recovery. Here we might have the same case. We could build the case for this climactic stop right there at that support level, and yet we are committing to the downside, and yet we are going below the levels of the support that were established by this temporary stop in action. And that's what bothers me here. This is different from this or from this. Do you see it the same way?
Yeah, I would say the thing here that gives me some sense that there might be support here is the March low, the April low, and the May low. That those together, and even the January lows, those are forms of support. And so I would be thinking that there could be a bounce of better quality that comes somewhere in here between, say, 1330 and 1350.
And we probably would be looking for the rally for the wick rally to rally, to about 1370, 1890, right to this resistance lines. And then, as Bruce has mentioned, if the price aggressively comes back into the range, then we would be probably rethinking, this type of scenarios. Okay, let's look at the long term. Bruce, right here, I just wanted to show the audience as to what precipitates, a kind of like a major move to the downside. And I found 3 instances before, looking at the current picture where we had some kind of laborious price action with some failures on the sign of weakness, the last attempt to go up as an upthrust, and then a reaction. Upthrust and then a reaction. Upthrust and then a reaction. So we're kind of in a very interesting spot against the resistance and with the analog patterns that are basically repeating themselves. How do you view this long-term picture?
Well, the thing that most is a concern to me is the fact that trend channel is so wide. And we'll see this with some FANG stocks in a few minutes, is that you have now the risk, now that you're back, that you're in the trend channel, the risk is potentially down to the demand line or the support line of that trend channel. And so this is something that we had. So that gives you a sense for a measure of the risk that could be latent here. And also the pattern is big. So if you look at the width of that blue box that you've drawn there, it's as big as any of the other blue boxes. And so that could be counted as a point figure count. And so that's a big cause. So if that's all distribution, if the CEO is selling in that blue box and distributing stock, then you really do have a cause that could take you back down to that lower line in the trend channel.
All right. Let's go to Corey. Corey, we ask you to look at the transfers, and it seems like transfers are deviating from the whole market, and they are actually marching much further down into the trading range and much faster, precipitating, the drop in the S&P and the Dow and the Nasdaq. What do you make out of that?
Yeah, it's just like the Russell. So and it's different today because we have much more in our economy than Mr. Dow saw, but he developed his theory with respect to the transports. And so the thought process is if companies are expanding, they're going to see lots of transportation and shipping and all those sort of things. So if the transports do well, getting the goods to the consumers essentially, that's a good thing for the broader economy. If not, if the market's going up but transportation stocks indexes are going down, not a good thing. Again, that's different today, 100 years later, but still the logic takes place. So we get the concept of confirmation, non-confirmation. So same conversation holds with what we talked about for the Russell and the Nasdaq, which is probably a little more appropriate for today's economy, but still, you are seeing weakness. Notice that we peaked in July there and have gone precipitously lower. We are also underneath, right? So it's markets have been going up. Transports daily have been actually making their way down. They are at the 38.2 fib. More so than that, I think, is that they are underneath the 200-day simple average. Last time we saw this was about May, where the market hit it, nailed it, and then rallied, as you mentioned, strongly up away from it. So let's see if that happens again. Hasn't happened yet, of course. And in fact, where this is the second, I'd say first major close beneath it. So we're in a precarious spot, and you can see, again, just building a technical analysis case for a potential rally off of the spot. But if it doesn't, if the market fails, transports go even lower, it's going to probably exactly fill out this range. Initial target a little bit shy of the 50%, which is 8. You're right. So it's basically the prior low. Look for the prior low, maybe even more precise, the 50% Fibonacci level, but even that could be a trend line. So I do have red beneath, really 9,080-ish, and green above in terms of expectations. So Same thing, if going back to Dow theory, if these transports start to fail, falter with the NASDAQ and the Russell, S&P and Dow will follow suit lower.
All right, well, let's look at the Wyckoff structure right here. So obviously a climactic action, change of character is the largest reaction after this move, automatic, defined by the automatic rally definitions, secondary test, phase A, stopping of the uptrend, upthrust in B, minus signs of weaknesses in B, another upthrust. Now here I put actually phase C. Now I put it with the question mark as a possibility that this could be a possible phase C. Well, if this is C, then we're definitely in D. And we kind of seen, Bruce, that the supply is increasing, effort is increasing here to push the prices down, and actually the price follows, and it follows with the character of the sign of weakness. How do we interpret this whole picture?
Well, first of all, when you have an upthrust after distribution and you get to the midpoint of the range, which is that about where we are now, this is the place where you start to, when you see it commit below the midpoint, you start to think upthrust after distribution, which means that this whole structure all the way back to the buying climax could be distribution. So that's substantially large. And then the other thing that you have to prepare yourself for is the idea that this market could liquidate down below the lows of the support level before it consolidates. Now, it's in a consolidation right now, but notice how it's a widening. It's making higher highs and lower lows. So you have it's a widening structure rather than a narrowing structure like yes, so on a big scale, that's a huge one. And then also the little one in August. So just in August of this year, yeah, everywhere. They're everywhere.
Yeah.
So broadening formations are distributional. They're showing, remember, if you've gone back and read my blogs about distribution, the thing about distribution is, versus reaccumulation or accumulation, is that the volatility increases as you go through the structure. So that means you're getting bigger and bigger swings, and the structure is becoming more and more destabilized. And it's exactly what we're seeing here all the way through and at every level. And so this is a destabilizing structure, and the reason you have increased volatility is because you have a CO community that is basically selling their stock and getting out. And so now the other thing to notice is look at the S&P. Compare the S&P to the transports. So the S&P is in this, nice, steady, advance, very normal, logical uptrend, and the whole time the transports are becoming more and more destabilized and appear to be making some kind of a distribution structure. And so this push up to 9,400 that we have just occurred, and now the markdown from that could be a last point of supply. And you could count from there over to the buying climax, which would be just a scary big count. Mm-hmm. And so we would want to segment that into smaller pieces. But look at the difference between what the transports are doing and what the large cap stocks, the large cap leadership's doing. And transports, the other thing about transports is that the whole idea of why Charles Dow broke out and created a transport index to the large cap industrial index, which is what he called it at the time, Dow Jones Industrials, is that the transports are sensitive to the economy. And so when the economy when businesses start to ship goods early in a bull market, transports respond right away. When the economy slows down and fewer goods are being shipped, the transports will reflect that typically before the broader indexes do. And so it's sort of a leading indicator. So.
Okay. I just want to throw in here maybe a slightly different view. So we're looking at the possible distribution pattern right here. I've been studying a lot, very kind of complex trading ranges where the bias changes from, let's say, a bullish reaccumulation bias to a distribution bias and then to a reaccumulation bias again. And that could happen because institutions, especially if the trading range is very prolonged trading range, and for a good example of that, go to Tesla since 2014, 15, up to the current phase, and you could see that there will be an area of supply absorption at some point that will produce some kind of rally, and then there will be some elements of the distribution that could take us significantly down, especially on the broadening information like this one, and then to register this kind of like a fear low, and then rally aggressively on institutional buying, consolidate in the reaccumulation, and then go higher. So this could be a possibility that we are in this type of complex structure where the bias is actually changes through the structure. Now, this yet to be seen, but I just want to throw this, Bruce, as an idea, and I'm sure that you kind of like see where I'm getting to here. Could we possibly just have a short-term bias to the downside and then just recover also kind of like in a significant way?
Oh, sure. And you could just take that count in the area of the upthrust, and that would be the thing that I would do, is I would count, say, from that 9,400 high up to the peak, take that up as a point figure count, and that probably would take us right to that. And so, yeah, you want to focus on a market like this in bite sizes, and to focus on this whole thing as distribution would be just crazy. It's just crazy.
Yeah, so. And we obviously a little bit, I think that we're a little bit driven right now by the short-term action because of it's right in front of us. It's what we live in right now. It's where our positions are. So therefore, let's just be cognizant, not to create just, a singular bias, but we have to discuss it within the timeframes of, long-term, intermediate, and short-term, of course. All right.
But that is remarkable, the difference between the transports and the S&P. That's like two very, very dramatically different picture. And so it's really worth keeping an eye on that. Yeah. And we will do that in these sessions as we go along.
Okay. I'm looking at the time, it's 3:10. We're supposed to finish at around 3:30. So here's the deal, guys. Usually at the market outlooks, Bruce and I, we go for an hour and a half. We just can't. We just have so much to talk about the markets that sometimes we go for 2 hours, maybe even 2 hours, 15 minutes. I think this is what's going to happen here. Especially I want, to hear also from Corey. Corey has some charts, so I'm looking forward to that. So for those of you who feel like you have to stop at 3:30 Pacific, don't worry. We are going to record. We are recording all of the sessions. You will receive the password tomorrow as an access to all of those recordings. And if you need to go, feel free to go. If not, stay with us. We're probably going to go to 4. If Corey, you're okay with that, we could go for that.
But of course.
All right.
By the way, I just want to make the point, there was some really nice comments, the people that have to leave, about the blog, and I'm grateful that you're all reading it and giving me feedback, and I really appreciate that. And I want to say that the equivolume that was mentioned earlier in David's presentation, that there's also a very cool thing. And I could actually tell a story about how this all came about in stock charts, but I'll save it for another day, is that there's, in addition to equivolume, Dick Arms did a plotting technique called candle volume. And so it's the equivolume where the bars are candles. And so, but the candle widths are a function of the volume traded. And it's just about the coolest chart you've ever seen. You can plot those on stockcharts.com. So I want you to be aware of that. It works the same way as equivolume. It's just you're looking at candles instead of boxes.
We
So anyway,
actually used that, Bruce, in the classroom, and
they're
it was
wonderful.
a little bit distracting because all of those different candles, you know, you kind of have to get used to it. But once you do, wow, there is such a visual identification, almost instant visual identification of those very important spots.
Well, and Dick's just such an innovative thinker, and he did the candle volume and the echo volume. So go check that out. I just wanted to say that before, if anybody has to leave before this is over. So anyway, that's all I wanted to say.
All right. Well, Bruce, let's come back here. This is your slide right here. You are so big on sector rotation, industry group rotations. This is a 1-year picture of all of the sectors based on the ETFs. And the bottom chart right here is the relative strength ratio line with the moving average. What do you see here as a theme? And just walk us through here, you know, some of the noticeable charts here for you.
Well, I think one of the best looking is utilities, which is a defensive play. And certainly it's starting to get some love. And I think that could be because it has good yields and also it's very defensive. The other one that's interesting is healthcare, because healthcare was such good leadership, and we can see that in 2017 and before, such good leadership, and now it's flirting with its trend channel, and the relative strength is starting to come off. So I would be keeping an eye on healthcare because it is on that demand line for some kind of a rally from here, and if it starts to slip through that, like the cyclicals to the right of it. Here, look at the cyclicals and the relative strength of the cyclicals there, and they're just breaking down out of their channel, and so that's
Bruce. And it seems like there is kind of like a theme here with all of the sectors. I mean, obviously, with an exception of the utility sector, which is just basically in the uptrend, we have quite a few of the previous leadership that are either on a breakout to the downside or about to go down, or they're already down. Like, you know, the staples right here just broke the trend and already below it. Cyclicals also below the trend lines, but something like industrial materials, technology, and healthcare, they are very, very close to that support. So is this telling to you about the overall market?
I think so. And for instance, look at the financials. The financials are very important. You know, they're important leadership, and the financials are coming after breaking out or coming back into their trading range. And there was a period of time there where they were just really showing good leadership, and that's very hopeful for the market. And now, if they don't consolidate here and get back above that trend channel again, I think they have risk to go down to the support line, and that would come. I think that would come because the market was going down in concert with the financials.
All right. So, let's look at the short-term picture right here. Corey, I know that you probably, don't look at this very frequently, but is there any specific theme in the market that of interest to you, either to the upside or to the downside, the one that catches your attention as the rotational play?
Yeah, I do some with sector rotation, and so I do it in terms of the Sam Stovall and a little bit of Martin Pring model. We'll talk about it later, but how the risk off goes with gold and how the market's pulled off and how you've seen treasuries go up. So I do more work on that, on the intermarket analysis than the sector rotation. But energy definitely is a standout bear. So just the way I use sector rotation, Bruce does so much of a better job. The way I do it, if I'm trying to do a swing trade, I'm going to do a bull flag or breakout or something, I'll turn to the sector. And if it happens to be a bull flag in an energy name, I won't do that because the odds favor of a failure versus something that's doing better. And you're right, the relative strength of them, just take a look at those. We want to find stocks that go, stocks in rising markets, rising sectors, relative strength, and of course buy on pullback. So that's my strategy. I don't do a whole lot like what Bruce does, but yeah, the standout for me is energy. That's just low. That which is weak tends to get weaker, and I'm also looking, as Bruce does, with healthcare, utilities, and then the defensive names like staples. If they're doing well, that's not a good sign for the market, and we're not seeing that. Utilities are doing well, but not staples and not healthcare, at least in terms of relative strength. So that's how I look at it.
Okay.
Technology is the best, maybe looking right now from that perspective.
I mean, look at the industrials, and you can see this in healthcare. See it in the industrials. You can see it in consumer staples. Look at the structure. I was a huge fan of industrials, in the uptrend, and now all of a sudden, you can just see the deterioration, and it has very distributional looking structure. Now it's below support, and you just don't. You just want to see industrials leading the way up.
Yeah.
Healthcare. Are you there?
Yeah.
Okay. Yeah, we are kind of a lost audio is being reported by several people. So if you guys are losing the audio, just stay in there. In a couple of seconds, I think it's gonna return. But we'll keep an eye on it. We didn't have any problems today, but maybe it's the last session, so the equipment is already a little bit moody. All right, let's look at the bonds. Corey, this is your chart. What do you see here?
So from an intermarket perspective, I'll just talk about that real quick. So the Federal Reserve is in, you mentioned earlier, it's really in an interest rate rising and a stimulus pullback or a buyback. So when they raise rates, when rates go up, bond prices go down. When they lower rates, bond prices go up. And that's been one of the most puzzling things. You saw it fall pretty precipitously in 16 into 17. So that's expected. We're not talking about technical, just in terms of bigger picture logic. If the Fed's going to raise rates and the market trusts the Fed, then bond prices will go down as yields go up, which is the way bonds work. But that's not what you're seeing now. So what I'm looking at is, again, these little volume spikes, that big volume surge in July, and the steady trend of volume going up. So from April, really that's April, right there. So all those 3 or 4, So you're seeing, and momentum as well. You see confirmation as price goes higher momentum, higher volume. That's good, that's bullish. So that's what we were actually bullish in our membership on bonds, as strange as that may be. And we still are to this extent. So as long as we're above the one, this is the IEF, it's the 7 to 10 year ETF. Other analog would be, or correspondent would be TLT, is your 20-year plus year, or just the futures contract. Anyway, to the extent that we're above 107.50, it probably does go up to the trend line and the 50% fib. And the IEF, which I like personally, it's about just shy of 109. So I would watch that. But in all things that I'm looking at and all things that I'm studying, this has been the number one puzzling factor, is why prices are going up when the equity market's going up. Usually it's the opposite. And I think more importantly, the Fed is clearly in a mode of raising rates. So either the market doesn't believe the Fed, as you hinted, they might not raise rates in December. All right, well, the market probably knows that if they're not going to raise rates, you're going to see this bullish drift. So it's essentially the market, when treasury prices rise, it's typically, not always, but typically bearish or risk off for the equity market. But also in a cycle where the Fed says, I'm going to raise rates, and the market goes up, it's kind of saying, hey, Fed, I don't trust you. I don't believe you. So that's what's puzzling me.
Yeah, that's a very interesting comment. I mean, what exactly is driving the prices up here? And obviously, this idea that December is going to be without any interest rate hikes, and also I'm also thinking about the overall political situation in the U.S. and maybe the Fed also seeing a little bit of the destabilization and maybe they're saying, okay, let's not rush into this whole thing and just see what's going to happen. So what if something happens? I mean, where is the flight to stability and quality will be? Well, bonds could be one of those things, and maybe there is a hedge trade that's happening here.
That'd be an easy play for most large funds to do. Yeah.
Yeah. Well, another point here, and we'll look at another chart right here in a second, and this is TLT that Corey has mentioned. This selling, and it's actually better seen on the previous chart right here. I like the target here of 109, and the reason why is because a lot of selling has started right here. So as the institutions are seeing the same prices, they might be inclined to start selling again.
Yeah, and that could. This is also a bear flag, so that's kind of what's got me puzzled too. So if it does start to break under and go from our resistance at 109, that's going to be a sell signal. If you get under 106, that lower trend line, that's down to the lows. But yeah, that's kind of what we're looking at there.
Sounds great. Bruce, you've done a blog on the PNF for the for bonds for TLT, and this upper right picture right here are your counts, and we basically hit the low with those counts. So what do we do next? Where do we go from here?
Well, we did build a cause from just say November to March for a rise, and we're getting it. And so there's the notion that we could get up into the areas that you just discussed are entirely possible. And so bonds are in a good uptrend. Now the thing though is that if you go back to the peaks of July of 2016, the bonds are nowhere near the high prices that they were at in that area, and there is distribution that seems apparent to me. Big sign of weakness, last point of supply, and so there's a big count, and so this count has lower prices. And the thing is that until the bonds rally up and take out the highs, then those counts are still valid. And it could be that somewhere up here, after say another minor new high, that you get a count that you could take somewhere in here that could confirm the larger count that goes down to these lower levels. And so this could be just a very big bear market rally.
Okay, so we just have to, I guess as a strategy, we just have to see what kind of failure of the rally, where exactly it's going to be, what kind of character of that failure we're going to have, and then just to strategize as to whether this is just a bear rally or is it just a possible, just temporary stop in this uptrend.
People seem pretty benign about bonds, and they don't seem to, really be concerned about them. And the thing is, though, if you get, say, a thrust above the 128 level here, and you get into the area of this gap, which you're kind of in it now, and you get up there, it's a natural place for selling to come in. And so there could be, and also then you'd have a count that you could take, and it could take you back down to that bigger point figure count, or which is a 109 to 111 area. So I think bonds are tricky, very tricky.
Could be the idea here, Bruce, that you mentioned that nobody believes, in what is happening with one. Maybe because they just have been so overbought for so many years, and so many institutions are in that position, and for them to get rid of that position, it's going to take some time.
Absolutely, and bonds are, based on yields, are historically low valuations. They're very expensive, and so based on yield, and so heaven forbid that yields would go up. I would hate to see that happen, but yields made their peak over a year ago, and so we're just in a very big period where, you know, you could describe it as a downtrend.
Okay.
Potentially. So,
All
I
right.
mean, I think the fact that those yields are high, were high over a year ago, and people don't seem to, they seem very like bonds are benign, makes me cautious.
Bruce, and how is that related to the dollar?
Well, here's the other thing that's interesting is because, you know, a lot of foreign investors own bonds, and they, you know, they foreign countries, and they buy bonds, and they put bonds into their equivalent of their Federal Reserve balance sheet. They buy U.S. bonds and put them in there. So they want to have a stable dollar. And when they have the dollar declining against their domestic currency, that makes their U.S. bonds less valuable. So if the bond if the dollar drops, that makes their bonds less valuable. And it wouldn't take much of a drop in the dollar to wipe out the yield that a U.S. Treasury bond can create in a year. So, because the yields are so low. And so notice what's happened since the end of the year. So in December, we went up and clocked. Now remember, you know, sort of the data talk about upthrust after distribution. Well, the thing about an upthrust after distribution is after it occurs, the market is in a liquidating mode and can march right down to support. Look what happened to the dollar. It upthrusted the buying climax, very important resistance area, and then it came back in. Look at the change of character in the new year in 2017. Look at the volume. And so, and this is in a blog, actually. You can go back and get this chart a couple of weeks ago. And so then you have a very feeble rally, volume on the rally to a lower high. That's a test. And that test is below the resistance line. And then the dollar just goes on a march down to the automatic reaction area, which is support, and actually goes through. But look what happens. We can draw a trend channel. So a typical trend channel, and you can see, look what happens. It accelerates. The dollar accelerates down to the lower bounds of the trend channel, which also is the support area. And both of those are breached at the area where it sets up a minor sign of weakness, potentially. And so, and then I think we also had a point figure objective that came in at that same place. So we have three things. This happens all the time in Wyckoff analysis, where you get three elements that all come together and point to a level. And so you can, here it is, here's our point figure chart. And that's also in the blog. And you can see here that we have a count. The lesser count, which is from the LPSY to the buying climax, is 2404 to 2364, and we went right to it. And since then, we've been consolidating. Now, what I'd like to see is I'd like to see the dollar have a really good bounce. And if the dollar does not have a good bounce here, but just consolidates at the support area, and then starts to go back down, then you have a bigger point figure count, 2220, 2260, that can come into play. And so how the dollar acts here is going to be really important.
Interesting. Corey, what are your thoughts on the dollar?
The same in terms of the support level, and this is UUP at 24. On the index, we had the similar level with those reversal candles and the peak up in the bull volume or the buy volume. So a different chart, but similar perspective, that the odds do favor a bounce up away from this critical pivot level. It is in a sideways trading range, so that's the expectation. That's a dominant thesis. But if it doesn't, once again, alternate thesis, if the dollar can't hold support, or if buyers can't step it in at all these probability levels of volume and momentum divergence and reversal candles and mega support, then it probably falls much, much, much lower. But at the moment, we're bullish until proven otherwise.
Corey, does this decline in the dollar put stress on the bond market?
I'm not sure about that. That's I'm more so on. It helps kind of float equities, but I'm not sure how it sort of ties into that at this point. I'm looking more toward the Federal Reserve in terms of the catalyst and how how larger funds treat, to an extent, their trust. Not the right word, but their. It happened with the Fed. The same thing. We're going to raise rates. No, we're not. No, you're not. And a bunch of it was correct. So I think it's more attuned to what the Fed is signaling. But a weaker dollar tends to be bullish for equity prices, tends to be bullish for commodity prices. And so that's ultimately what you're seeing at the moment. But a failure here significant. I'm sorry, go ahead.
Yeah, so you have this crazy thing where dollars dropping and bonds are rallying.
Yeah, that's not usual.
It just seems counterintuitive.
Yeah, well, in intermarket relationships, they bend. They don't necessarily break. Well, at times, different catalysts, but they are allowed to bend. And so we are seeing a bending, but different catalyst. Martin Pring does a lot of great work with that, with respect to how, and John Murphy for that matter too. Different catalysts, different points of time, different things that we're looking at. QE1, QE2 twisted the relationship, and now geopolitics. There's so much we can talk about beyond technical analysis, but certainly is bent. We'll certainly put it that way.
Well, both of you gentlemen mentioned the possible rally of these levels, a bounce. I would probably look at this as an analog to that particular bounce, where we are committing below, and then, look at what kind of rally, guys, is going to come after this. Are we going to have the same type of rally or not? Is it going to behave in the same manner of absorption, where there are attempts to go down and yet there is no result to the downside? And as both Bruce and Corey have mentioned, if the rally and subsequent maybe even consolidation is going to be very, very small, very timid, then most likely we're going to see lower prices. Yeah. All right, let's go further down the list. Oh, Bruce, this is your favorite. This is something that you wanted to discuss so much.
You guys,
please, go ahead.
Drag me kicking and screaming into the Bitcoin world.
I don't trade that. I don't know it. Corey does not trade this.
No, I don't trade it. No, stay away from this.
I did this chart because we wanted to do a Bitcoin chart, and so this is our proxy, which I looked for other charts of Bitcoin, and I didn't like any of the charts, so I made this one on stock charts, and it's just an amazing chart. And so I'm like, oh, it's like Bitcoin. Let's pay attention to this. Anyway, classic reverse use of trend line. So I typically draw a little box on the points that the trend line originates. Now, look underneath. That demand line or that support line is also valid in its own right because there's 2 points adjacent that you can draw it on. So both these trend lines are parallel, but they both are drawn from their own points. Now, you have a buying climax and a secondary test that breached the upper trend channel that goes all the way back to 2015. And now we've just breached it again on this rally up. And this is just a wicked, there's a buying climax, a secondary test, and it went down to under 300 from 550, something like that, and then turns around and rallies from up to 703, or where it is now. It rallied actually a little higher than that. And so this is it's just remarkably wicked advance. And this is a really just an aggressively marked up instrument. And
Bruce, your analysis is so spot on right here. I think that you secretly trade in it. You just don't. You just don't tell us. What about this one right here? I think this is what you're referring to.
Bitcoin, I wouldn't admit it.
Might I say really quickly, you're being very, very kind with your parabolic scale, your logarithmic scale. If you've made it just an algorithm, an arithmetic chart, it would be off the rails.
I couldn't draw it. I couldn't draw it. That's what I'm saying. You're very kind. So basically, what I've done is I've zoomed in here, so that you can see the throw over on the buying climax on the secondary test. Tell me that trend line's not important and valid in a throw over, and look at the decline. And so now we have another run up. And I actually, if I was to make a political comment, I mean slightly political because I'm just not that kind of person, but is that I think that this kind of speculation in an instrument like this has a lot to do with sort of the profligate Fed. The Fed has just pumped so much liquidity into the system, and so it's almost as though, you know, sort of the new age is like, don't trade gold, trade Bitcoin, and so now you have just this wicked parabolic advance taking place in Bitcoin, and even though you have, sorry, go ahead.
Real quick, I don't think it was one of you, but I saw recently a chart somebody had I put together gold and Bitcoin, just, you know, arithmetic chart. And as much as gold has moved from 900 to 1600, all the way back down, etc., as much as gold had moved, it just looked flat. I mean, compared to Bitcoin at 4,000, gold over the last few years was flat.
Corey, everything looks flat compared to Bitcoin. I look flat
exactly
compared to Bitcoin.
Me too, we all do.
So,
right.
Yeah. So anyway, I don't know what else to add other than look at the qualities of absorption occurring after the automatic reaction, and then you have a run up and then a spring, just a classic spring, and then it just gets real dull and quiet and comes back above its moving average. And late July, and it just is absorbing, and then off it goes again. So I'll be very curious to see what happens if it gets back below this trend line again.
All right. Well, Bruce, you tell us if you have any trades there. You know, we'll follow you.
Okay.
Yeah, maybe.
Okay.
Well, I might be flattened by Bitcoin.
Oh dear.
Corey, have you had any recent trades in oil?
I do trade oil, and mostly on an intraday basis. And so we've caught this rally up and the way down. So essentially, I didn't send a chart to you, but the playing up toward the 50 and then down away from 50. So that I was able to capture a few intradays. I don't really swing trade it necessarily, but not often. But I did capture intraday moves on the way up toward our 50 target and then subsequently down away from it in terms of a bias or expectation. So it's in a trade. You're seeing it here. It's in a trading range, sideways maneuver. And this bounce up away from 47 was also a fib level, obviously a trend line, and you're seeing extreme price. So I'll let y'all take over, but this is a good sort of way to look at it.
No. Give us more here.
More. Yeah, it's in a parallel rising trend line. And so oil itself has been relatively flat from 2016. So what the chart doesn't show, just to kind of reference, was 147 per barrel back into 2008 or 9 or so, before it crushed. And so what we're seeing from 2009 to present, and it's a long time, but it's perspective, is it's kind of a constrained, compressed, laborious, I don't use the word dead cat bounce necessarily, but rally up. So this is essentially in a major bearish phase. So that's the bigger monthly perspective on oil, down from 147, I think, was the ultimate peak. And so this consolidation range may be even considered a rounded reversal. But if we're looking for the next few weeks here, I'd watch that trend line as it pushes back toward 50, maybe even up higher to about 52 where your levels are.
Yeah, kind of the same opinion on oil here. We actually made a really good call in this area right here, especially after this reaction. This was an ability of the price to go below the levels of 42. I was actually in the swing trade, and Corey, you know, I like the swing trade, so somewhere here,
good
that was my trade. And then we said that it's going to hit 50 or 52. So I still think that there is a possibility here, especially after this bar right here, for the price to at least touch 50 again. or possibly go to 52. And we have the PNF count right here of this area to 51, 54. These are Bruce's counts right here for the distribution. This count worked really nicely. You know, I actually used it for my trade right there. And it seems to me, Bruce, that, you know, this is kind of like range bound, not just in the short term, but in the long term picture, which is basically between 55 and 40, 43, 60, something like that. So something has to give. And this whole story, you know, the fundamental story about OPEC against the US shale production, I mean, it's not going away anywhere, because OPEC countries, they need to make more money, so they don't want to contract their you know, supply that they give to the market, so they don't want to contract their market share. At the same time, you know, if the price is sustainable above $40 in the US, the shale production is actually booming. So I think that there is some kind of equilibrium price between 40 and 60, and this is where we're probably going to stay for quite some time. What's your technical view, like a long-term view on this structure, and what do you see short-term?
Well, a couple things that stand out to me. We have this rally that's taken place from $42 on up to 50, and this whole time the energy sector has been actually getting worse and worse, and I think that's quite odd. So the energy sector isn't buying this rise in oil prices, and so that's one thing that really stands out to me. The other is that this is sort of a feeble rally, and if it finds resistance, or if it has trouble making its way up to 52, this could be a last point of supply, and it may have to go down. And of course, I have a count at $36. So, and that's a very, I think it's a modest count. It's not even counting the whole structure. And so I do believe that it's possible that $36 could be out there. And if you look at the transportation index, and we see that oil prices are sort of low and stable here, and it's not helping the transports, because the transports, huge cost for them on their income statement is energy costs. And the fact that energy is really, you know, stable here and not in a rising trend late in a bull cycle, and you have the transportation index looking a lot like this chart. You know, they have similarities, and so I just think that there's kind of it's kind of a mixed picture here. I would think that with a bullish economy, you have it was just estimated that third quarter GDP could be 4%, and you have a transportation index that's not acting better. It looks like it's coming off of an upthrust after distribution, and it's not acting better in the face of good earnings and a strong economy, and energy prices should be getting a good bid and getting higher prices because of the strength in the economy. Mm-hmm. So this is kind of a mixed picture.
I see your logic there, yeah, and I actually like it very much, because if the transportation index is showing us some weakness in businesses, you know, and transports are very sensitive to the business picture, you know, obviously they're gonna use less energy, and less energy meaning more supply of oil, and therefore the prices, you know, going lower. Another argument here for the technical structure here, if you guys look at this structure right here, and if you slightly tilt your head to the right, you kind of would see this as a horizontal trading range, where you have your phase A, phase B, low, high, and then this could be a phase C potential upthrust action. I actually love when the price goes up on an attempt to go to a new high, and maybe it will touch 50, maybe it will even go to 52. But the failure of such effort is an extremely good signal, you know, for the counter trend to that action. And obviously we do have a legitimate trend line right here, which if being reversed and based on Bruce's scenario right here, we could easily have it potentially go to 42, 43 as the first target, and then to 36 as, you know, the count was taken right here. All right. Well,
one more quick thing, Ramon. From August, connect the highs from August, October, make it into what we call a rounded reversal, almost like a saucer pattern. So the highs, so just kind of connect them. They form a little rounded reversal.
Okay, August of 16.
Yeah, right there. So go to the highs. Just connect the highs and draw like an arc trend line. So start at the highs.
To the highs right here.
All of them. Sort of draw circles around all the highs and then connect. There you go. So keep going.
All right. Crown formation.
Yeah, it's a rounded reversal. Rounded. It's a distributive pattern, but that's what I'm looking at too. Is a rounded reversal / inverse saucer pattern. That's long-term bearish.
Maybe another one right here.
But wait, yeah, it probably does push up a little bit higher. But right, if that does play into the game, that's an ultimate bearish. I think that would get us to Bruce's targets if that does play out.
Well, then the minimum target is going to be this low right here.
Yeah,
because this is where it should end. And then obviously we have another one that has started somewhere here. So we could potentially see a much lower. This could be a very interesting campaign.
Yeah, short-term bullish, longer-term bearish.
All right, gold. Okay, so we did mention gold. Bruce, this is from your blog. You already mentioned in the blog that it seems like possible campaign is underway. So maybe we could talk about this area right here.
Well, when I look at Bitcoin, this looks flat to me.
That's true.
So yes, we have really been showcasing gold since the beginning of the year, and pointing out that we have these, clocking in with these good year-end lows year after year, and that we had a really good one to a higher low after a minor sign of strength at the end of 2016, and that there's been an attempt to rally off of that. And so at the June second quarter end, there was an attempt to push down into the end of the second quarter, again making another higher low, and that has resulted in a rally, which we were looking for. And now we're up against this resistance area, and so it'll be interesting to see if we can get some follow through and get gold up to the top of this very large structure, and get it to maybe accelerate its advance. And if it accelerated its advance, it would still look flat compared to Bitcoin.
Yes. Corey, you were talking about the intermarket analysis of gold and...
Right. On that chart. So I have the same, again, no comparison, we have the same thing with respect to if the dollar does start to fall beneath those levels, that could push commodity prices higher. If we do turn to a more risk-off perspective in terms of equities falling, that could also be a fear play or a protective defensive play that could send gold prices higher, etc. Right. Yeah. So that's what we're looking at. Now, I'm more interested in this. It's a weekly chart, but I'm more on the daily with respect to this 2017 sideways trading range, just shy of 123. So those little 3 prior highs and the 3 prior lows. That's what I got my focus on the daily chart of the 2017, the trading range. So if we do get the breakout, you do have a projection target higher, 130. Yeah, so that's what I'm looking at there. So that's what my focus is on. But right now it's pushing into the highs. So I'm going to be neutral at this spot, 123, 122.50, and the GLD ETF there. So if this range does continue, it's back to 115. That would be with the case of potentially the dollar strengthening, could send commodity prices lower. So that's it. This is why one reason I do intermarket analysis. If gold is at upper resistance and the dollar is at lower support, that's kind of a good play to have. Either they both break on through them, which is helpful to know, or they both fail and they continue in their spots. So that's one that to push. When both interconnected markets, or in this case anti-correlated or negatively correlated, when they're both at pivot points, that's really key to watch what happens, even if you don't trade them both. It's good to know that.
We have three good forms of support for the dollar here, and
right.
And you know, to gold's benefit, it's been able to show some strength, even though gold or the dollar has stopped declining.
Yeah.
And but nonetheless, if the dollar can find a bid here and start to turn back up, that could very well be the case. And so it'll be very interesting to see what happens. This is a really important place right here.
Yeah. Good little spot to do a swing trade.
Gentlemen, yes. We have 5 minutes left, so we're gonna go really fast. Okay, so let's look at FAN stocks, and maybe there we might stop the whole session.
This is a blog that I did a few weeks ago, Fantastic Trend Lines. And these trend lines are all legitimate in their own right. I mean, legitimate, they're always legitimate, but it's not we draw parallel lines off of one point typically. But in this case, you'll see that these trend lines are all consistent in and of themselves for their own construction. And so here you can see with Facebook that Facebook, you know, got above its upper trend line, consolidated, and then had a good leg up. And so Facebook is by far the strongest. You go over and look at Amazon. Amazon was flirting with its supply line and was sort of bouncing around, and then it had a big up thrust and a failure, and it's back in its trend channel. And so you can see that there's two trend lines at work here, and it's getting very close to a key support level now. If it gets through that, I think that the next trend line, or the bottom trend channel, which is a legitimate trend channel on its own, 2 points are touched, could be the next target, which would be a huge decline. So I would be watching this steeper trend line very closely. And you could really say the same thing. So since I wrote that blog, that post, they've gone up and come back in again. And I think that there's a form of vulnerability for these to go down to 1 or 2 trend lines. And the one that was most dramatic was Netflix. Had a big run up on earnings, and then it turned around and came right back in. Of course, it's the smallest trend channel. So anyway, that would be basically my summary on this.
All right. Corey, bullet points here on each and one of them.
Yeah, real quick, what I did just to kind of save time in the thing was look at the weekly, daily overlap. So just quickly, Facebook is stronger volume, stronger momentum. It is pulled away from the 20, so the next move probably is a pullback, and that's your red line on the daily chart. So that's probably what's going to, at least it should happen, logically speaking. And that takes us to about 165. You do have new momentum highs with volume, so it has the possibility to go even higher. That's confirmation, that's good. But the most recent move, like we're saying for everything else, watch your support, watch your pivots, especially the daily chart right there. Odds favor a push up. If it doesn't, look down to the 20 or 50-day moving average right there.
Mm-hmm. Looks climactic to me on both the weekly and the daily, especially on the daily right here with that bar.
Yeah, okay. So that puts some vulnerability into the stock there.
Mm-hmm. Amazon,
same thing. Now it's actually at the 20-week average, about 960 per share. Look at the volume on the weekly. Not a whole lot to discuss there, but again, just showing the difference in 2015 where volume and momentum and price were rising. That's a good thing. That's bullish. We're not seeing that currently. So we're seeing a little bit of flatlining or declining momentum and volume. Daily chart. So we got a good little short. This is one I did on the membership, and I actually did myself a little bit on the push into the falling 2050 week exponential at just shy of 1,000. Yes, it's trading range. We shorted into that little pullback. So in the most recent pullback, where it hit the right there, I call it kind of a cradle trade. It's when the EMAs cross themselves and the price rallies up on, if you look really closely, falling bullish volumes. The market went up to a target on bearish or declining bull volume. It's a great little spot to play a short-term swing trade. And that was at this point successful. Your pivot is simply just shy of 960. It's your weekly average and this multi-pivot point that I drew for you on the daily. Beneath that, you pop down to 900.
All right.
Bruce mentioned Netflix too, that little, and you did too, the overshoot and Netflix. That is kind of cautious in making us in terms of these V-spike reversals. Stocks that go up with high volume and high momentum tend to keep going up. The exception is what we call a V-spike reversal, which is violent, jumps up, high volume, high momentum, and then it's over. So trends the majority of trends end with divergences and distribution, and it takes a while to form the pattern. The exception to that rule is a V-spike climax. Climax is when everybody's jumped in bullish, there's no more bulls, and the distribution takes on a more aggressive move. So it's more of a Wyckoff term than I'm used to using, but I use the word V-spike climax, and you're seeing that there. Same thing. You're at the 20-week, just about moving average. Pivot point's about 166. That's a prior high, and the daily moving average for Netflix. Failing that takes us down to the 20 or 200-day simple, just about 150 per share, which is that yellow highlight.
Mm-hmm.
And yeah, last one on the Google. Same thing. So we are in a more pronounced. Let's start with the daily chart first, actually. In a more pronounced sideways trading range in Google. A little high, yeah. So that's I think the clearest one there. The rest of them are going up. Google's going sideways. Look at all that bear distribution volume. Look at your momentum divergence. Now let's go to the weekly chart. Yeah, the distribution volume. And you're seeing it there too. So at the pivot, at support, there's your range. If you fail about this 925 level, you're trading down shy of 900. It's a Fibonacci for you. 885-ish is going to intersect your 200-day simple. If I can sum these all up, for the most part, the FANG, the big little name stocks and big high-tech stocks are at critical support levels. If they support, the market supports. That's where the market is. They bounce. If the market fails, they fail. These are your targets. So we're not making predictions. We're making scenarios once again. And it's a bounce scenario. You play bullish, you play these up. Bear scenario, breakdown, you have targets. I would argue use your targets, use your stops according to what we call the departure from these levels.
All right, great. There is a little bit of the labeling here from us on potentially where all of the FANG stocks are in the labeling sequence. And Bruce, let's just finish with this, and then let's definitely stop and close out the whole conference.
Just a supply line, reverse use of trend lines there on the semiconductors. We wanted to do that because the semiconductors are important leadership. This is where the animal spirits are in the market, and so a strong semiconductor index leads to helps the market go up. So we can see a buying climax on a throwover of this trend channel after preliminary supply, and then an automatic reaction, secondary test sets a trading range. So we have a trading range here, and volume has come in. You can see there's a substantial amount of volume off the peak, and so that just makes us cautious. We continue to get volume. Now, the one thing I would say here is you're getting a lot of volume, you're not breaking down. And so they can't get any follow through to go down to support. Maybe that could be eventually bullish. I do believe that there will be an attempt to go down to some level of support, and if there's diminishing volume and an ability to get good follow through, that could maybe be argue that this is a reaccumulation.
Maybe they can't say goodbye to those positions. The institutions, they're like, oh, it's been such a big winner for me. And it's still kind of like in the upper part right here of this whole big trend. So, but if it's gonna go down, Bruce, I think that this is where acceleration is gonna happen, right in this area, because this is where institutions that were in love with the theme, with this theme is gonna just like sell, and they wouldn't care.
I mean, look at that big change of character with the buying climax, and then look at all the ground you give up in one day, and then it's you know, pretty consistent break, big change of character. So I don't know. I'd just be on my toes with semiconductors, and I would need to see a lot more evidence that there's absorption going on here before I would. And I still have a few semiconductor stocks, so you know, I'm you know, waiting for final confirmation because these are campaign stocks. So.
All right, gentlemen, great work. Let's close it out. Bruce, I know that Corey has something to show us, some offering, Corey.
Yeah, you have the link for us?